chart that you are more familiar and have more confidence. So let's start by looking at long run ASAD. X-axis, Y-axis. Real GDP is equal to Y, is equal to total output, is equal to national income. And here we have price level. And the two price levels that we are most familiar with are CPI and the GDP deflator. Nominal over real times 100. Remember that. Now let's throw in our friend long run aggregate supply, which is our potential output. When the economy is at full employment, only structural and frictional unemployment, you can produce your optimal outcome, YP, potential output, long run aggregate supply. This is Baby Bear. It's just right. Aggregate demand for consumption, investment spending, government purchases, and net exports. Primarily household spending, firms buying capital stock. When the government buys something, not transfer payments, no money handouts. When they're actually buying something. Finally, NX, which is exports minus imports. And with green. Short run aggregate supply. Here we go. What I've drawn here is long run macroeconomic equilibrium. Our short-term output is at long run aggregate supply, so we know that we are at full employment. PL1, maybe I'll rewrite that. PL1, YP, there we go. Some notes, some things to think about as we look at this graph, and we'll do it in a brown pen. As real GDP increases, output increases, national income increases. My question is, what happens to employment? Does employment have a positive or negative relationship with the x-axis and ASAD? And the answer is it's positive. As we move further to the right, employment will increase. On our y-axis, we have a correlation with inflation. As the price level rises, that is inflation. And so we have here our very familiar long run and short run aggregate supply and aggregate demand graph. What we'll be looking at now is bizarro land, what I like to call the Phillips curve. Well, that's what it is called. Our Phillips curve has a lot of shared relationships with ASAD, so it gives us a language of familiarity, which makes it easier to deal with and learn about. We'll start by drawing our plane, quadrant, and on the x-axis we have unemployment rate percent, and on the y-axis we have the inflation rate in percentages. Let's go back and look at what we're familiar with from long run ASAD. The x-axis here has a positive relationship with employment. Here we have an unemployment axis, which means that we've flipped the polarity of the x-axis. Because of that, the Phillips curve is largely going to behave as a mirror of the behavior that takes place in ASAD. We're already familiar with what the classic school does to how it fixes a bubble and a recession, but we're going to see it here behaving as a mirror. The y-axis is an inflation rate axis, so it's going to behave largely the same as the y-axis here. So really, we've only flipped the image into mirror image form. Now let's see what we can bring over that is familiar to us. And we have our long run Phillips curve. The long-run Phillips curve represents the natural rate of unemployment, or full employment, when you only have structural and frictional. And in that sense, we should see that it very much correlates to long-run aggregate supply. You function at your potential output when you are functioning at full employment. They are married to each other in that sense. The curves of the Phillips curve represent a trade-off between unemployment and inflation. And the vertical slope of the long-run Phillips curve shows us that in the long run, there is no trade-off. In the long run, you will function at full employment, regardless of the price level. The price level is irrelevant of being at full employment in the long run. It can be higher price level, lower price level. In the end, you're going to get back to just structural and frictional. In the short run, however, we do have a trade-off between unemployment and inflation. Short run Phillips curve. I don't know why pi is the symbol for inflation, but it works, and so we're going to roll with it. So here we have a long and a short run Phillips curve denoting long run macroeconomic equilibrium. We have, right there is our current output, so we are at full employment, and this would be your inflation rate, which would be the change in price level year to year. It's not exactly the same, but they're related to each other. What gets interesting about the Phillips curve is how it explains the classical school of economics shift to the long run when you begin at disequilibrium. So I'm going to go backwards, and I'm going to draw us a new equilibrium point over here. Let's do this. Okay. And recession, fair enough. Aggregate demand, PL1, and Y1. How would we denote, we'll label this point A. How would we denote point A over here in Phillips curve land? Well, if the current output is below potential output, will your employment be higher or lower than it should be? It should be lower, so you have greater unemployment. So that means that our recession point here should be over here. That's what point A looks like. And now you start to see how it behaves as a mirror. Because the polarity of that x-axis is flipped, we see that a recession appears to the right of long run. Because in a recession, your unemployment rate is greater than the natural rate. So now is where we're going to start learning. Here you see an inflation rate A that correlates to our actual short-run equilibrium, point A. The difference between this inflation rate and this inflation rate is where the magic really starts to happen. At point A, our actual inflation is different than our expected inflation rate. This creates a very weird world to live in. But before I talk about that, let me show you how we know what the expected inflation rate is. The intersection of short-run Phillips and long-run Phillips always denotes the expected inflation rate. What people going to bed at night think will be the inflation rate. What people waking up in the morning think will be the inflation rate. In this scenario, however, is there a difference between what people think the price level is going to be and what the price level actually is going to be when they go to the store. In a world where the actual inflation rate is lower than expected, you go to the grocery store, you want to buy a gallon of milk, and it costs $1. And you think, wow, that's crazy. Is there something wrong with this milk? And then you go to get some eggs, and they cost $1. And you say, this is crazy. Maybe there's a huge sale going on, and I don't know why. And then you go to buy some fruit, and it's ridiculously inexpensive. And obviously, these are over-exaggerations to point out the point of the story. However, if you keep going throughout your day and buying things, and they cost less than you thought they were going to, you might go to bed at night thinking, this is the greatest day ever. But when you wake up tomorrow, and it repeats itself, and the day after, and it repeats itself, eventually are you going to change what you think the price level should be? Are you going to change your inflationary expectations? When that happens, we can show that in a Phillips curve very clearly, because it's impossible in the long run for there to be a difference between what the price level actually is and what you think it's going to be. Eventually, do you have to change your expectations? And in a Phillips curve, we very clearly can illustrate a lowering of inflationary expectations here. What we've done is we've shifted the short-run Phillips curve down, which is a synonym of a decrease of inflationary expectations. It's a synonym because that intersection of long run and short run is the denotation of expected inflation rate. And so as your expectations fall, the only way to do that is to decrease that short run trade-off between unemployment and inflation back to where it is now expected and actual, where your expectations begin to match reality. Here we see our expectations being drawn down to match the reality in which we live in, also called adaptive expectations. We're not going to get into that right now. But this is the magic of the Phillips curve. We see that the reason the short-run Phillips curve will shift down in the long run is because our expected inflation needs to adjust to the reality of the world that we're living in. Let's see how that correlates back over here to ASAD land. In ASAD, we talk about being in a recession, and we talk about workers not having jobs, and we talk about firms having rising inventories. As workers and firms find themselves unable to function in the market as they previously did, will workers eventually accept a lower wage? Firms that have inventories, will they eventually be willing to sell those inventories at a lower price? So imagine that you're a carbon fiber manufacturer and you're unable to sell your inventory. Eventually, will you lower the price of your carbon fiber? Let's say you're an engineer. Eventually, will you be willing to go back to work for a lower wage rate? As engineers are willing to go back to work for lower wages, does that decrease the cost of employees? And the answer is yes. Because if you were Boeing and you could hire a proven unemployed aerospace engineer for a fraction of the cost of the one that you currently have, are you going to let your employees know, guess what, wages are going down if you want a job? And if you're Boeing and you're looking to buy carbon fiber, have your input costs fallen? So what we see in a recession is there are downward pressures on wages and prices. And eventually, when there is a difference between your expected and actual inflation rate, as workers and firms lower their inflationary expectations, meaning that they are willing to accept lower wages and prices, that decreases the input cost of production. And we see that in the long run, short-run aggregate supply increases, bringing us to a lower price level and full employment output. This, my friends, is the mirrored function of ASAD and Phillips, and I believe that the beauty of Phillips curve is that it very clearly tells us about the story of expected and actual inflation rates and how that can be the explanation of the classical school in ASAD. Going back to point A, in a recession, eventually will workers and firms lower their inflationary expectation, decreasing input prices, increasing SRAS, and bringing us back to full employment output at a lower price level. We see it on both sides of the line here, just behaving as a mirror. That's lesson 1. Let's hope it went well.